Very good morning to all and welcome back to today's Daily Dose of Market Insights. I hope that you all have a great and restful weekend. Very good morning to all. This is Kelvin here. Today will be Monday, the 29th of September 2025. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into today's full suite of the daily dose that includes all the intraday technical outlook on all the 12 broad-based cross asset classes that we cover on a frequent basis, let's have a recap what has taken shape yesterday in terms of the weekend, and as well as on last Friday in terms of relevant economic news data and news flow, and as well as their impact on the intraday movement on the respective broad-based cross asset classes. So let's start with last Friday. So last Friday we have a slew of key Tier 1 US economic data releases, which is the PCE data that consists of the PCE inflation trend, which is the so-called the favorite inflation gauge that the US Federal Reserve tends to monitor the broad-based inflation trend in the US. So for both the core PCE index on a month-on-month basis and on a year-on-year basis came in within market expectation. So it came in at 0.2% for the month-on-month. The core PCE that is strip out the volatile food and energy prices, and the core PCE price index, which is on a year-on-year basis, that's moved out those seasonality factor, also came in within expectation at 2.9% year-on-year. So overall, it's still rather elevated. I would say it's still within we call it not say within a certain percentage point above the 2% long-term inflation trend target that the Fed desired over here. But so interestingly over here is that it didn't actually go beyond expectation. It's still at 2.9%, and also the personal income and personal spending also came in slightly above expectation. So personal income month-on-month for the month of August and personal spending for the month of August came in slightly above expectation at 0.4%. What market is expecting is 0.3%, and personal spending came in at 0.6%. What market is expecting is at 0.5% for the month of August. So yes, even though it came in slightly above expectation, there is one leading economic tier 1 data, which is the Michigan Consumer Sentiment finalized figure for the month of September. Over here, it continues to remain lackluster over here because consumer sentiment tends to be forward-leading over here, because how consumer feel will potentially impact further personal income and spending in the next few months. So consumer sentiment figure, the finalized one for the month of September, came in slightly below the preliminary figure that was released about 2 weeks ago at 1 week ago at 55.4. So it came in at 55.1, remains below 58, continues to inch downwards. Previous month finalized print of August, it was 58.2. So if you look at the trend of the Michigan Consumer Sentiment finalized print for the month of September, it continues to print a lower high over here. So you look at the 5-year trend, yeah, it going to inch downwards, a very clear lower high and lower low. So indicating lackluster consumer sentiment as compiled by the University of Michigan, indicating that potentially going forward, personal spending and personal spending, that means i.e. retail sales going forward, will be also on a weaker mode over here. And with PCE inflation being in line with market expectation, that potentially allows the US Federal Reserve to kickstart its interest rate cut cycle after enacting its first rate cut 2 weeks ago. All right, for the month of September. So with that actually continues to see a high chance of a 89.3% odds as being depicted by the trading price behavior of the Fed funds futures traders compiled by the CME Fed Watch 2. So market participants in the Fed funds futures market continues to assign a high probability of a 9% chance that the Fed will do another 25 basis point cut on the next meeting, which is on the 29th of October over here. So that actually increased by 2 percentage points before the release of the PCE data, and as well as the release of the finalized University of Michigan consumer sentiment data for the month of September. So previously it was at 87.7. Then after the release of this data, it jumped by around 2 basis points, 2 percentage point higher to 89.3. And what's interesting over here is that the next meeting in December, if you look at the aggregator tab, previously I shared with you on last Friday that the potential third cut for 2025, previously it was like a coin toss at around 58%. So after the release of last Friday slew of key US economic data, which is the finalized University of Michigan consumer sentiment for September and the August PCE data, this probability jumped from 58% to 63.6%, that the market participants has assigned a higher probability right now that the Fed will do another third cut before 2025 ends to bring the Fed funds rate to 3.5% to 3.75% for the last meeting of this year, which is on the 10th of December 2025 FOMC meeting. So with this betting odds starts to rise for to assign a higher probability of 63.6% chance that the third cut may take shape on the 12th of December 2025, that causes the US stock market to jump. So after 3 consecutive days of decline, starting from last Tuesday, Wednesday, Thursday, we see a bullish reversal on the 4 major US stock indices. So that also came in within our expectation. For those who recall, in my daily dose of market insight on last Friday, I highlight that the SPX, the Nasdaq 100, and the US Wall Street 30, which represent the Dow Jones Industrial Average, is all at a tipping point for a potential bullish reversal. And that bullish reversal indeed has taken shape on last Friday, where all the 4 major US stock indices rallied and closed in the green on by the close of last Friday session. So the top performer will be without doubt will be the Russell 2000, up by almost 1%, 0.97% to be precise. The reason why, because the Russell 2000 is very, very sensitive to interest rate stances by the US Federal Reserve. So if the US Federal Reserve is inching towards a new round of an interest rate cut cycle, as being depicted by the probability I shared with you guys earlier on the CME Fed Watch 2, that actually compile the trading behavior of the Fed funds futures traders over here, the Russell 2000 will tend to move more significantly against the other major major US stock indices. Pardon me. Why? Because the Russell 2000 the component stock of the Russell 2000 has higher gearing ratio. That means, i.e., they tend to be much more highly leveraged as compared to the component stocks in the Dow Jones, the Nasdaq 100, and the SPX 500. So lower interest rate, higher probability of a lower interest rate environment, higher probability that the Fed will kickstart its new interest rate cut cycle will have a much more significant impact on the Russell 2000 index. So that actually explains why the Russell 2000 is up by almost 1% on last Friday, followed by the Dow Jones Industrial Average up by 0.65%, and the Nasdaq up by 0.4%, and the SPX 500 up by 0.6%. So overall, it's still I would say that a minor bullish reversal day on the major US stock indices. And also with the higher probability of the third rate cut being priced in right now by Fed funds futures trader, that also saw the dollar sold off as well on last Friday, and it continues to drop in today's Asia session over here. So this is the 5-day rolling performance as of 29th of September. And if you look at the 1-day rolling performance, taking into account of the start of today's Asia session, the worst hit on the dollar was against the Japanese yen. So the yen strengthened significantly against the dollar today, up by 0.4%, or the dollar weakened significantly against the yen, down by negative 0.4%. All right, over here. So later I'll share with you the latest intraday chart and the outlook on the major dollar pair. So with the dollar weakening as well, the gold price also rallied, as you could see. So if you look at the gold price over here based on the 1-day price performance, okay. Okay, so gold price for today is up by 1%, all right, up by 1% as we are speaking right now. So due to a rather weak US dollar. So later I'll share with you for gold price. In fact, on last Friday, I do highlight there's a potential bullish continuation minor chart configuration that has already formed on gold that is supporting future bullish momentum on gold price over here rather than the start of a medium-term multi-week corrective pullback in spot gold XAU/USD. So later I'll touch on the chart. All right, on the intraday outlook. Okay, so this is the first segment of today's daily dose. So let me now move on to the second segment, which covers the intraday technical outlook on the broad-based cross asset classes. So before we jump straight into the intraday technical outlook on the euro dollar, let me very briefly touch on the dollar index first. So the dollar index is very important. Why? Because it gives us a broad overview of the dollar strength or dollar index over here. So this is a barometer of indicating a general, we call it gauge on the US dollar. So the dollar index over here, what you could see is that on last Friday, it managed to actually drop over here. Okay, it dropped right exactly at below the resistance level of 98.90 over here, 98.90, and right now it's trying to close back below the 20-day moving average, where previously on last Wednesday and last Thursday there was a strong bounce over here. So it seems to us that it may now starts to revisit the 97.3 level again if we have a daily close below this 50-day moving average. And one of the reasons why the dollar is so weak right now is due to that potential US government shutdown, where both the Democrats and the Republicans failed to agree on a funding bill. So later I'll touch more about that when I come close to the end of today's daily dose over here. So given this rather lackluster movement of the US dollar index that is attempting to have a daily close below the 50-day moving average. So over here, I would not have been so convinced of this euro dollar weakness earlier that I have on last Friday. So even though it still remains below my resistance level, which is at the 1730 level, which is the 20-day moving average, but my conviction right now has been reduced for it to revisit the 1630, 1615 level on the euro dollar that previously that I have on last Friday with that rather bearish bias stance for the residual push down. So with the dollar index getting weak, breaking below 50-day moving average, so my conviction for a bearish bias on the euro dollar has been reduced as well. So for today, I will maintain a neutrality stance on the euro dollar. Upper limit of the neutrality stance will be at 1750, slightly above the 20-day moving average, which is very close to the upper limit of this ongoing descending channel upper limit that has been in place since the previous hit of that 4-year high on 18th of September, and also the minor swing high area of 25th of September as well at 11750, that confluencing it. So neutral between 11750 and 11680. So if we have a bullish breakout above 11750 later and an hourly close during the European session, then I could validate a potential start of a bullish impulsive upward sequence for the euro dollar to seek out higher high for the next intermediate resistance to come in at 11820 followed by 11860. So that's for the euro dollar. Next up will be the sterling pound, the pound against the dollar. So with that also reduced my bearish conviction on the sterling pound as well, given the fact that the dollar index is breaking below the 50-day moving average. So with that, I will flip to a neutrality stance for today. No conviction to play that bearish move down to retest the 133.30 figure, which I have on last Friday. So neutral between 134.65, which is very close to the 50-day moving average, and the lower limit of that neutrality zone for today will be 133.90. So if we do have a bullish breakout above 134.65, then I would validate the potential start of an impulsive up move sequence for the sterling dollar to, in first step, to test the next intermediate resistance zone at 135.10, 135.10, 135 1.35 over here, 1.3535, which is also the 20-day moving average. Breakout above 135.35 may expose the next intermediate resistance at 135.95 over here. Right, so my apologies, I didn't expand my screen, so that let me expand my screen now, so that hope that you guys could have a better visualization of the chart. All right, so the screen is being extended now. All right, so I covered the sterling dollar. Low conviction for my bearish push down earlier that I have on last Friday. So for today, I will flip to a neutrality stance between 134.65 and 133.95, and I'll be watching the upper limit at 134.65. A breakout above it, if an hourly close, will validate the next potential impulsive up move sequence on the sterling dollar. Okay, next up will be the, give me a minute. All right, so next up, give me a minute, sorry about that. So next up will be the Aussie dollar over here. Okay, so the Aussie dollar on last Friday, we turned neutral over here. So it played around with the neutrality limit at 65.30 before staging that minor bullish reversal scenario and close back above the 50-day moving average. And upon shaping this minor bullish reversal scenario and a close above the 50-day moving average, the hourly RSI shaped a bullish divergence as well, indicating that the earlier sell-off from last Wednesday all the way down to last Friday, the downside momentum has eased off. So with this positive element, I will flip back to a bullish buyer stance from today from last Friday neutrality stance with a short-term pivotal level at 65.30, 65.20. So 65.20 will be last Friday intraday low over here. All right. Okay, at 65.20, that will be last Friday intraday low. So flip to a bullish bias for today for a potential minor recovery scenario to take shape. First resistance level to watch will be 65.80. A breakout above 65.80 potentially sees 66.20 next, which is the minor swing high area of last Friday before that 2 days or 3 days of sell-off take shape. Intraday sell-off take shape. Only a bearish breakdown below 65.20 will invalidate today's bullish bias / minor recovery scenario to expose the next near-term support level at 65 figure and even 64.85, which is the minor swing low of the 2nd of September. That's for the Aussie dollar. Next up will be the dollar yen. So very interestingly, the dollar yen over here, let me open up the chart of the dollar yen on a medium term time frame, which is the daily chart. Okay, so this is the dollar yen. Okay, so the dollar yen has a bearish reaction right exactly at our medium-term pivotal resistance level at 149.90, which is the upper limit of this ongoing multi-month / medium-term ascending wedge configuration that is still in play since the low of 22nd of April this year. All right, taking a look at these two gray converging line. All right, over here, which is a ascending wedge configuration. All right, so there's a bearish reaction of it at 149.90, and also there's a bearish reaction of exactly at the pullback line of this former minor medium-term ascending trend line support now turns into a pullback resistance on the daily RSI, indicating the lack of upside momentum. Okay, that has taken shape in the prior 2 days from last Wednesday and last Thursday over here. So on a hourly time frame where we construct our intraday daily outlook over here, still recall previously we do have a neutrality bias between 149.90 and 148.95/75. So right now it's actually testing or challenging the lower limit of this neutrality zone at 148.95/75. So with that bearish reaction of the daily time frame chart and also the hourly RSI breaking below this parallel ascending trendline support that was formerly in play since 5th of September, indicating the return of a potential short-term bearish momentum on the intraday basis. So we will flip to a intraday bearish bias for today on the dollar yen, but still we in that rather choppy medium-term ascending wedge configuration that has yet to be exited out on the downside, which is 146.30. So with that, let me share with you what are the first resistance level to watch for today in any case of any pullback. So the first resistance level to watch out for will be at the 149.46 level. This for minor pullback, given the fact that the hourly RSI has really hit the oversold level. So any minor pullback, I will use this minor pullback as a bearish bias over here below 149.90 medium term pivotal resistance level. after this minor pullback has taken shape, a breakdown below 14875 will potentially expose the next intermediate resistance level in first step at 14820, followed by 14780, 14750, which confluence with the 50-day and the 20-day moving average. However, if we start to see a squeeze up above 14990, today's bearish bias view will be invalidated to see a further push up towards 150.45 in the first step. Above 150.45 exposes the 3rd of March and 28th of March 2025 minus a medium term swing high area. Okay, there's a typo error here. Okay, at 15115, 15130. So flipping to a bearish bias in any case of any bounces, with the bounce resistance to watch out for at 14946. Medium term pivotal resistance to maintain this bearish bias potentially will be at 14990. That's for the dollar yen. And that's also sum up the intraday technical outlook on all the 4 major FX dollar pair. Now let us proceed with the intraday technical outlook on the major stock indices, starting with the Hong Kong 33 that is representing the Hang Seng Index. So the Hong Kong 33 bounced up as expected, right exactly at the rising 20-day moving average. So with this strong bounce that has been seen on last Friday, I will adjust my short-term pivotal support level higher to coincide with this rising 20-day moving average that managed to see that minor bullish reversal take shape on last Friday. So that will be at 26,060. So using a slightly adjusted short-term pivotal support level for today on the Hong Kong 33, 26,060, maintain that bullish bias view. First resistance level to surpass will be at 2665. A breakout above 2665 will revisit its current 4-year plus high, which was seen on 18th of September, not too long ago, at 26,940. Only a bearish breakdown below 26,060 will negate today's bullish bias. To see a slide down towards 25,860 again. A breakdown below 25,860 will trigger a deeper minor corrective pullback sequence to revisit 25,500 next. We also confluence with the rising 50-day moving average and as well as the lower limit of this medium-term ascending channel that is still running from the low of 2nd of June 2025. So that's for the Hong Kong 33. Next up will be the Japan 225. So the Japan 225 managed to actually gap down. It actually gap down today due to a weaker US dollar against the yen over here. So given there's this gap down over here and it's coming very close to the next support level at 44,560. So potentially there could be a bit of whipsaw going on forward over here. But given the fact that it's still above this rising 20-day moving average, I will flip to a neutrality stance for today for now. All right, given of the yen strength that is coming into play, that could potentially curb the movement of the dollar yen, curb the movement of the Japan 225, that is curb the bullish movement of the Japan 225 that is representing the Nikkei 225 on a very short term intraday basis. Okay, let me adjust my movement here. So this will be my lower neutrality level, which confluence with the rising 20-day moving average at 44,560 and also the intraday low of 19th of September before that minor bullish reversal take shape but can't break above the 45,960 range resistance level. Right, that is still in play since 19th of September. So neutral between 45,560 and 45,270. Okay, so I round it up. Okay, let me put it in writing. 44,270. Over here. Okay, so if in order to increase the odds of a return of an impulsive bullish upmove sequence, price action got to break above 44,270 and in first step revisit 45,960. A breakout above 45,960 will increase a higher chance of the impulsive bullish sequence reviving into the Japan 225 to seek out the next intermediate resistance at 46,430/46,580. However, a bearish breakdown below 44,560, we saw the confluence the rising 20-day moving average, will see a deeper minor corrective decline unfolding. We in this medium-term ascending trend line that is still in place since 23rd of May, and also we in this medium-term minor ascending channel that is still in play from 1st of August over here. Okay, let me delete this. So breakdown below 44,560 exposes the next support level at 44,050. If this level couldn't contain, it will potentially see further weakness back down towards the lower limit of this minor ascending channel that is still in place from the low of 1st of August 2025, and also confluence very closely with the minor, this area here. All right. Okay, with this congestion area of 9th of September. So that will be at 43,435. Okay, so that's for the Japan 225 that is representing the Nikkei 225. Next up will be the Germany 30 that represents the German DAX. So the German DAX is going to recover. So on last Friday, we do have a bullish bias towards the 20-day moving average, which is at the 23,790, 23,735, which is so the minor swing high area of 16th of September and 19th of September. And given that it has a bullish breakout on last Friday above this level, above this intermediate resistance zone, and also close above the 20-day moving average. So potentially right now, the odds of a recovery has increased for the Germany 30 just based purely on the price action on last Friday. So with that, we will continue to maintain a bullish bias slash recovery stance for the Germany 30 that is representing the Germany DAX for today, with a slightly upward adjusted pivotal support level for today that will be at 23,600, which is the former minor swing high area of 26th of September. Now turns into a pullback support level that managed to survive during the European session on last Friday. And if you take into account of this most recent rebound that's been seen on last Thursday, all the way up to today's intraday high so far, that 23,600 also confluence very closely with the golden ratio of 61.8%. All right, so using an adjusted pivotal support level for the Germany 30 for today, 23,600, maintain that bullish bias. Next resistance level to watch will be 23,900. A breakout above 23,900, seek out the next intermediate resistance zone at 24,090, 24,155, which is the congestion area of 26th of September, and as well as the minor swing high of the congestion area of 26th of August, and the minor swing high of 2nd of September. Only a bearish breakdown below 23,600 will invalidate today's bullish bias stance to see a choppy downward drift to revisit the swing low of 17th of September and 25th of September, acting as the next intermediate support zone at 23,390/23,310. So that's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30 that is representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average, i.e. US Wall Street 30 CFD index, managed to bounce as expected. Over here, fast approaching our resistance level at 46,570, and also managed to clear above our first resistance level or intermediate resistance level that we have on last Friday at around the 46,230 level over here. So this will be the first level over here to watch out for a potential minor pullback. So as long as this minor pullback didn't break below my adjusted slightly upwards pivotal support level that I have for today on the US Wall Street 30. So previously on last Friday, I put it at 45,780, 45,690. So this level is very crucial. Why? Because it's the former bullish ascending triangle range resistance over here. Now turns into a pullback support level that managed to bounce on 17th of September, and also managed to do that minor bullish reversal on last Friday as well. So because this bounce has already been taken shape, and I will slightly shift upward the pivotal support level to 46,040 over here. And if you look at the rebound off from the 20-day moving average all the way up to today's current day intraday high, that also confluence with the golden ratio of 61.8% over here. So using a tightened, slightly adjusted upward pivotal support on the US Wall Street 30 for today, 46,040, maintain that bullish bias scenario on the US Wall Street 30, resistance level to watch on the intraday basis, 46,560, followed by the current all-time high on 23rd of September at 46,750 / 46,870. A breakout above 46,870 will induce a higher high, which is a clearance of the current all-time high. Very clearly, we will now start to see a bullish impulsive upward sequence, seeking out the next intermediate resistance level at 46,160 next, which is the Fibo extension level as well. Only a bearish breakdown below 46,040 will revisit the next key important intermediate support zone at 45,780 again / 45,690. That's for the US Wall Street 30. Next up will be the S&P 500, which is the SPX 500 CFD. So price action rallied as expected and hit our resistance level at 6,670 / 6,680 that I highlighted on last Friday. So with that, I will tighten my short-term pivotal support level to 6,615, which is also the golden ratio after the minor bullish reversal on last Friday, all the way up to today's intraday session high. Okay, the golden ratio as well, 6,615. So using a adjusted pivotal support level at 6,615 on the SPX 500, we will maintain that bullish bias. For it, a breakout above 6,680 will potentially seek out a higher high and a brand new all-time high, which is being defined by a Fibo extension cluster level at 6,730, 6,745. Only a bearish breakdown below 6,615 will revisit the 20-day moving average again, which is indicating another choppy round of minor corrective pullback at 6,580 / 6,560. So that's for the SPX 500. Very similar on the Nasdaq 100 as well. Managed to shape that bullish reversal and almost hitting our resistance level on the intraday basis at 24,710 that we highlighted on last Friday. So with that, I will have a slightly adjusted upwards tightened short-term pivotal support level at 24,305. So using 24,305 as my short-term pivotal support level. So a slightly higher level to look out for any chance of any pullback will be here, will be at 24,485, maximum 24,305. That will be my tightened short-term adjusted pivotal support to maintain this ongoing minor bullish reversal / recovery scenario on the Nasdaq 100. Above 24,710, potentially seek out a new resistance level and a brand new all-time high at 24,890 in first step, which is being defined by a Fibo extension cluster level. Only a bearish breakdown below 24,305 will revisit the all-important next intermediate support zone. That means, i.e., the start of another choppy corrective pullback scenario at towards 24,140, 24,050, which is also confluence with the rising 20-day moving average. All right, so that sum up the intraday technical outlook on all the major stock indices. Now let us proceed to the commodities market, starting with the gold XAU / USD. So for gold XAU / USD continues to inch upwards, and now as you are speaking, it managed to finally break out that bullish ascending triangle range configuration that was taken shape previously from 23rd of September all the way up to last Friday. And in today's Asia session, we do see an hourly close above this 3,785 level. All right, 3,776 level over here. So right now is having indeed a fresh all-time high again for spot gold XAU / USD over here. So with that, I will actually now tighten my pivotal support level towards the lower limit right now on this minor ascending channel that is still in play since the low of 22nd of August this year. All right, so I'll tighten it to over here, given that we have an hourly close above this bullish ascending triangle range resistance level. So that will be at 3,776 3,753. Just to confirm. Yeah, 3,753. Okay, let me do some adjustment over here. 3,753. Given this positive price action that is taking shape right now on Gold XAU/USD, breaking above the minor ascending range resistance as we are speaking. 3,353. Okay, 3,353. Then this will be my next support level to watch, no longer a pivotal support. Okay, so let me change this. Okay, so now tidying everything up. Okay, so bullish breakout above former bullish minor ascending triangle range resistance now turns into a pullback support at 3,776, 3,785. I will tighten my pivotal support level right now for Gold XAU/USD to 3,753 to maintain this bullish bias for this ongoing bullish impulsive upmove sequence to continue. Next resistance level to watch, which is a fresh all-time high at 3,000, new fresh all-time high potentially at 3,820/3,840. Followed by 3,865 in the first step, which being confluenced by a bunch of Fibo extension levels, as well as it continues to head towards the upper limit of this minor ascending channel that is still in place since 22nd of August 2025 low. Only a bearish breakdown below 3,753 will negate today's bullish bias to see another round of choppy minor corrective pullback, exposing the next near-term support level, which is the minor swing low of 25th of September and 25th of September at 3,720. A breakdown below it may see a deeper minor corrective pullback towards 3,688 next. So still maintaining that bullish bias on Gold XAU/USD with a tightened short-term pivotal support now at 3,753 as it hit a fresh all-time high as we are speaking right now. Next up, lastly, will be the West Texas crude oil. So West Texas crude oil on last Friday, we turned bullish for it to do a squeeze up to hit the major descending resistance that is been in place since 28th of September 2023 high, and as well as the 200-day moving average at 67.20. So it rallied up as expected, almost hit the 66.90/67.20 level and did a bearish reaction of it. So with that, elements has been mixed right now, given the hourly RSI is still holding on to a parallel support level over here. Okay, at around this horizontal line here at 44 level. So with that, I will flip to a neutrality stance for today. So neutrality stance between the West Texas oil between 66.90, 67.20. Lower limit will be last Friday pivotal support zone that managed to stage that bullish reversal, 64.90/64.55. Only a breakdown below 64.55 will invoke another round of minor bearish movement within this complex sideways range configuration that is been in place since 5th of September low that has taken shape between the important the key meetup between US President Trump and Russia President Putin. Exposing the next support level after a break below 64.55 will be at 63.70, which is the 20-day moving average. Only a break below 63.70 will induce a much more bearish movement towards the lower limit of this minor sideways range configuration at 62.15, 61.85. So that's for West Texas oil, and that also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, today's key event to look out for will be a meetup between Trump and the leaders of the both party, which is in the Senate, between the Democrats and the Republicans, to hopefully to solve this issue of the squabbles between the Democrats and Republicans to avert this 1st of October government shutdown over here, because right now there's this funding bill where the Democrats in the Senate try to block the Republican from passing. So this bill, once it passed, it could prevent the US government from shutting down on the 1st of October and allows the government to get funded until mid of November as more discussion is able to prevail between to solve we call it the hit blocks between Republicans and the Democrats. So right now, the Democrats are insisting that this funding bill must include an extension of the healthcare subsidy that got eradicated and as well as the restoration of budget cuts to healthcare. All right. So whilst the Republicans is holding their stance, preventing this bill, preventing the Democrats, we call it request, and they say that this issue can only happen after averting a shutdown. So there's this we call it a ding dong going on, or say brinkmanship going on. So as this brinkmanship takes shape, between today and tomorrow, there could be a higher volatility that's being seen across all asset classes. That also causes gold price to actually shoot up as well, and the dollar weakening because of the risk of this government shutdown. But so far, the US stock indices has been rather bullish after last Friday minor bullish reversal. So something to look out for today's event over here. And if you look at the calendar, there's no key event that is taking shape during the European session, except that for a bunch of Eurozone officials speaking, starting from 2:50 p.m. Singapore time all the way up to 3:30 p.m. Singapore time. Three Eurozone officials speaking that could influence the movement of the euro dollar, the euro crosses, and potentially the German 30 CFD index. And no key US data that is out today, except for two US officials, Fed officials speaking at 7:30 p.m. Singapore time will be Fed Wheeler, then followed by 8 p.m. Fed Hammock over here. So that sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.